Before a bank will lend you a single dollar on a commercial property, they run one number. DSCR. Debt Service Coverage Ratio. If you don't understand this, you don't understand how CRE financing works. The formula is simple. DSCR equals net operating income divided by annual debt service. Debt service just means your total mortgage payments for the year, principal plus interest. If a property has $120,000 in NOI and your annual mortgage payments are $80,000, your DSCR is 1.5. Most commercial lenders want a minimum DSCR of 1.25. Some require 1.30 or higher depending on the asset class and market. Here's why it matters. A DSCR of 1.0 means the property is barely covering the debt, zero cushion. If vacancy ticks up or a tenant skips a month, you're short. A DSCR of 1.25 means for every dollar of debt service, the property generates $1.25 in income. That buffer is what lenders require to sleep at night. Here's the flip side. The higher the DSCR requirement, the lower the loan amount you can qualify for at a given income level. If the property makes $100,000 in NOI and the bank requires 1.30 DSCR, the maximum annual debt service they'll allow is about $77,000. That limits how big a loan they'll write. This is why sophisticated investors pay close attention to interest rates. When rates rise, debt service increases on the same loan amount. That means the same property, same NOI, now has a lower DSCR. Deals that worked at 4% interest rates suddenly don't pencil at 6.5%. DSCR is also how lenders stress test deals. They'll run your numbers at a higher vacancy rate, or a higher interest rate, to see how much cushion you'd have in a downturn. Here's the one sentence to remember: DSCR is NOI divided by debt payments. Lenders want at least 1.25. Below that, the deal doesn't get financed. Subscribe and I'll see you in the next one.